Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken. Today is July 1st, 2023, and our model portfolio is up 6.95%. Our goal here at Spy Trader Now is to beat the returns of the S&P 500 buy and hold investor. And we call the S&P 500 SPY because the ETF that we buy and sell, the symbol is SPY, otherwise known as spiders. And so our goal here is to beat the returns of the buy and hold investor. Currently, we are not accomplishing that goal because the buy and hold investor, it currently is up year to date 15.77%. and our model portfolio is up only 6.95%. So we have some catching up to do in order to accomplish our goal and beat the returns of the buy and hold investor. We do that with a very simple 3-position portfolio. We either have shares of the ETF SPY, or we do options, or we have cash. Currently, this is how our portfolio is invested. Here are some past returns for the model portfolio for Spy Trader Now. In 2022, fantastic year of 21% return compared to the S&P 500, negative 19% return. And here is 2021, and in 2020 we doubled the portfolio. If you want to see how I do that, and by the way, we do this with investment grade capital, not trading capital. So I trade the portfolio in a conservative investment funds position, and I trade this portfolio myself. So I have a vested interest to make sure that this portfolio succeeds. Anyways, if you want to see how I do this, go ahead and hit that subscribe button, ring that bell, and smash that like button down. Last week, the S&P 500 for the week had a fantastic up week, 2.32% to the upside. Here is the trade that we made during the week. So we had an in-the-money call option. And what I was waiting for was I was waiting for a pullback of 3 to 5%. I was going to close out my option when we hit the 50% Fibonacci retracement. We never even hit the 38.2% Fibonacci retracement before this market bottomed and went north. It only had a correction of 2.8%, which is not even 3% correction. So it's so mild of a correction, it's practically nothing. So that tells you a couple of things. Number one, it tells you how strong this market is if it continues to go north. And number two, it also increases your risk level entering with new funds at this time because of two reasons. Number one, you had a very shallow correction, leaving room for a bigger correction further in the future. Also, we had a gap on Friday. Normally, these gaps get filled, meaning that you're going to come back down here. So here is the option, the trade that we placed during the week. It was sent out on Friday the 30th, 7:29 p.m. Pacific Standard Time, and we ended up rolling out our option. So we closed the current option, and then we did a buy. So we bought to close the current option by buying the 6/30 2023 417 strike for $26.17. But then we turned around and sold 2 more call options, and we went out 3 weeks this time. We went out to an expiration date of 7/21/23, 417. We kept the same strike, and we got paid a premium of $27.79 for taking on this trade. So that's how we played it, and this is our current play that we have right now. We want to see how this gap is going to get filled during the week. Next week, we have a shortened trading week. Monday's a shortened trading day. Tuesday is off. So it's going to be a shortened week overall for the trading for next week. Here are some trades that I've made in 2023 with the most recent trades right here. If you want to see all of my trades going back for 3 years, you can head over to spytradernow.com. There will be a link down below for you to do so. Here is our equity curve of our model portfolio year to date. Here is the equity curve for the SPY buy and hold investor year to date. And here is the two equity curves combined on a single chart on a percentage basis, because we want to compare our portfolio against the buy and hold portfolio. Our goal is to beat that return. Currently, we're not doing that. I've played the portfolio extremely conservative in 2023 so far, and the S&P 500 has just been unbelievably on a tear with just about a 16% return year to date. Unbelievable. Here is the Fed Chair Jerome Powell. The last interest rate hike was done on May 3rd, 2023, 25 basis points, bringing the federal funds rate to 5 to 5.25%. The next announcement will be on July 26th, and we may have a 25 basis point rate hike on that meeting. Now we're looking at things from the presidential election cycle theory. And what it states is that depending upon what year the president is in will determine the approximate returns that that year provides. Currently, we're in year 2023, the third year of President Biden's term, and historically, this has returned 16.3% in the third year of the presidential election cycle. Currently, we are at 15.77% year to date for the buy and hold investor, which is a 0.5% of meeting this historical average. So we've pretty much accomplished this. We've met this goal right here of reaching that historical average. Now we're looking at things from a bond market outlook, and the bond market, which is 4 times the size of the stock market, is telling us that we should be out of the stock market because there's risk. There's too much risk. We have an inverted yield curve and we have rising interest rates. So that is what the bond market is trying to tell us. Now we're looking at things from a valuation standpoint. By the way, I've got the link here. All the links for everything that I'm bringing you will be down in the description below the video. So you can click on any one of those links if you want to explore anything. But let's look at it now from valuation. We're overvalued according to CMV. And we are at the standard deviation of 1.3. So that takes us here on a standard deviation chart. We are currently 52% above the PE ratio on a normal historical 10-year average. We are at 30.8. Normally, we're at 20.2. So there's caution going long as advised. It's difficult for you to base your trading decisions just off of this information because you can be overvalued for long periods of time. Now we're looking at things from the CNN Fear and Greed Index. This is our friend Warren Buffett, the sage of Wall Street. Currently, we are at 80. We are in the extreme greed section. 1 week ago, we were at 72. So greed has increased. Now, the month has actually closed trading, but the new month, July, hasn't started trading yet. So we don't have the new month populated here yet. But considering that June, going back 20 years on a seasonality basis, is normally the second worst month of the year to invest, had an unbelievable positive month, up 6.48% for the month of June 2023. Now the next month, which is July, has a 74% probability of closing higher than when it opened. That's pretty good odds. So we're going to have to see how we can get into this market and go long for the month of July, and then maybe taper off after that. So that is kind of like what we're going to be doing as a game plan moving forward. Now we're looking at a 20-year chart, monthly S&P 500. You can see the nice bull run we had since 2009. Downward trading channel broke out above it, and it has been heading straight to the moon ever since. This curve, this angle is unsustainable. We're going to have to eventually come back down because it's an unsustainable angle. But The MACD has just crossed above its signal line, which is a very positive event for the long term. This is a long-term outlook. Slow stochastics is already above its signal line heading north. So as long as we stay above this line, we're going to be in a bullish condition for the S&P 500. Now we're looking at an intermediate term outlook. And on an intermediate term, we've broken into this trading range between 450 and about 425. So between this peak right here and this peak right here, this is the trading range that we are currently in. And slow stochastics heading north, MACD heading north, and slow stochastics is above 80 and just traveling sideways. Now we're looking at it from a short-term outlook, daily chart, and you can see everything that's happened right here. Only the 2.8% pullback before we turned around. The gap up right there, you can see the gap really good here in the thumbnail. Our expectation is for us to come back down, fill the gap, probably get out of our covered call position, hold the stock, and then see what the market action is going forward. MACD just about ready to cross above its signal line, slow stochastics heading north. It's a bullish looking chart, and look at the nice volume on that up day, nice volume going up. So let's see if this will carry through and bring us higher above this 443 level heading into next week, or fill the gap and then start to head north. Now we're looking at a ratio chart. RSP, which is the equal weighted S&P 500, compared to SPY, the normally weighted S&P 500. So we have three charts up here all in the same chart. And the ratio chart is in the black and red. The green is RSP, the equally weighted, and the blue is SPY, the normally weighted. Now, since 2009, we know that we had a nice bull run from here to here. And normally, during nice bull runs, the equally weighted will outperform the normally weighted S&P 500. And so that's what we normally want to see. We've come down off of a cliff on the ratio chart here recently and 2 times in the past. Both times in the past, going back 20 years, we moved sideways for about 6 months or so, and then the MACD had a crossover, and then shortly after that crossover, then the S&P 500 just went on a tear here and right there. So the MACD has bottomed, but it has not crossed above its signal line, giving us that confirmation signal that we have clear blue skies ahead. So we are closely monitoring this, and we're a little bit early in the game because in the past 2 times it's done this, we need about 6 months of sideways action on the ratio chart and then the crossover for us to really feel confident, which kind of takes us into the seasonality basis where you're going to have the summer doldrums, and starting in October and then November, ending in somewhere around October, November, then this market picks up for the remainder of the year. That's why looking at a pullback of 3 to 5% is extremely conservative. It may be even a more conservative pullback of 7 to 10%. Then this market will bottom out and then turn up and have a nice positive year and still end up with that 16% return. So a lot of unknown variables, but all I can do is tell you what the charts are telling me right now. Now we're looking at the VIX, so the volatility index, and we are at rock bottom. We were in a low trading range between 20 and 16, dropped below 16, and have been moving sideways ever since. And when you're at this rock bottom, eventually you're going to come out of this rock bottom and head north. When the when the VIX heads north, the S&P 500, which is this black line, heads south, meaning you're losing money. And when the VIX is at a high level and traveling down, the S&P 500, which is here in black, is moving north. So currently, here's your S&P 500, here is your VIX. The VIX is eventually going to go up. When that happens, this S&P 500 is going to be traveling down. We would like to be on the right side of the market when that happens. Currently, I'm positioned really nicely because of my in-the-money call, because if the VIX were to jump up in the next 3 weeks and the S&P 500 were to come down, then I would be in a great position because my option would be losing money. I can buy it back at lower dollars, still hold on to the ETF SPY, and then as the market finds its footing and goes north, we will already be invested in shares of the S&P 500. Now we're looking at a chart, one-year chart, S&P 500 on the Think or Swim platform, where we have standard deviations. +2 and -2 in gold, +1 and -1 in pink. The midpoint here is the dashed green line. We are currently between the 50% mark between the +1 and +2 standard deviation. Going back for 1 year, we've only been in this territory right here during this time frame. And so there's a lot of white space here where we haven't spent a lot of time in this area. So if this market is going to prove itself, it's going to continue to, head north. 95% of all trading takes place between the +2 and the -2, meaning that there's, on a probabilities basis, you only have a little bit of room before you're going to butt your head up against the +2. And with the gap up and being close to the +2, there's a higher probability of sideways action or come back down, fill the gap, and then come back up a little bit. But definitely a bullish looking chart from generally speaking. Now we're looking at the same chart, but instead of going back 1 year, we're only going back for 3 months. And I was, and I kind of am, in buy the dip mode. The only problem is that a 2.8% dip just wasn't a big enough of a dip for me in order to buy into it and go long. I was hoping for that 3 to 5% and I was willing to go long at 4%, taking us into this area here. And I even had and I still have it up here, my alert at 426 to be alerted when the S&P 500 reached it. It never reached that level. My alert never got hit. And that is why I did not take on more of a bullish, more leveraged position of going long than my current position, which is an in-the-money covered call. I have just given you a ton of information in this video. Now comes the critical thinking. What are you going to do with that information? My market summation as of July 1st, 2023, according to me, Spy Trader Now, and I am your host. My name is Ken. I am going to sit tight, and I'm going to see if the gap gets filled next week and what the market action is. I want to see what the week's action is. I already have the in-the-money call in place, but it's really only good for me if the market corrects, so I can buy to close my in-the-money covered call at a profit. Otherwise, I'll close out of it. I won't gain money, I won't lose money, but I would like to gain money, so I would prefer to buy it at a lower dollars. Next, this coming week, we have the holiday of July 4th, so the market will be observing that. It will be closed Monday. On July 3rd will be a shortened trading day. So that's going to wrap up this week's video. And I hope I gave you some valuable information and some ideas in this video. If you have not done so already, go ahead and hit that subscribe button. Ring that bell to be notified. Help me promote this video by smashing that like button down. And I wish you good trading.